Hey guys, Whitney here. Welcome to the Passive Investing Made Simple show. I'm your host, Whitney Elkins-Hutten. Today, we're going to be talking about how to protect yourself from bad operators and Ponzi schemes. Now, if you've never joined me for one of these webinars before, we do this webinar live every Tuesday. And you're in the right place if you want to figure out how to turn your active income and savings into passive income and long-term wealth. Now, you see, maybe you've tried investing in passive real estate and passive deals before, and you just realized you just couldn't get comfortable with the investment. You didn't know what you didn't know, right? Or maybe you actually invested in a deal before and you're like, oops, I made a mistake. Or you are a seasoned investor and you simply just want to sharpen your skills. If that's you, you're in the right place. Now, before we dive into today's topic, if this is the first time we're meeting, again, my name is Whitney Elkins-Hutten. I'm the Director of Investor Education here at PassiveInvesting.com, but I walk the talk. I'm not just a talking head here. I've actually scaled the portfolio in doing what you're doing, which is trying to scale wealth through passive real estate. I've been a partner in over 800 million in active real estate deals, totaling 6,500 in residential units, 15 express car washes, 2,200 self-storage units. I've flipped in over 5 million in residential real estate. Not only do I do my work here with you as the limited partner in my role as Director of Investor Education and PassiveInvesting.com, but I also do individual work with investors at Ash Wealth. Now, I've outlined my journey from starting to invest in real estate in 2002 to today in my book, Money for Tomorrow, How to Build and Protect Generational Wealth with Bigger Pockets. And I love contributing back to the community through podcasts such as these, like the Passive Investing Made Simple show, as well as the Multifamily Investor Nation show. Now, all these numbers here are just kind of vanity metrics, right? It's to help you understand that, I am in a position, I've done what you've tried to do before, or what you are trying to do. But really, all of these numbers lead to one result, which is how do we get 100% control and choice on how to spend our time? Because that's really what I'm here as in my role as a passive investor, what I'm trying to do. And I'm sure what you're trying to do too, right? We're trying to use our active income or our active involvement, whether it's in scaling a company or scaling our own personal business. We're trying to take all of that and figure out how to buy back our time, get that control and choice, maybe location independence, and create that impact in the world. And again, I outlined my journey through tapping into what I call the 5 freedoms in life in my book, Money for Tomorrow. But we can also help you do that here at PassiveInvesting.com. We've acquired over $2 billion in assets and currently have $1.5 billion under management. We have over $400 million funded in our fix and flip fund and multiple exits across multiple asset classes. Now, today, we're going to talk about how to avoid, working with bad operators and, heaven forbid, getting into a Ponzi scheme. Now, today is not financial advice, tax advice, legal advice. Take everything that I say and make sure that you bring it back to your investment team, especially before making any sort of investment decision. Now, really, at the end of the day, how you protect yourself is really through good, solid vetting. But I'm going to give you some additional questions to add to your due diligence process. That's going to be in the how section, but I want you to take these to heart because some of these I've actually had to learn by trial and error. Yes, I'll show you an example of a Ponzi scheme that I've unfortunately invested in. Now, why is it important that we learn how to add this additional layer of vetting to our process? Well, it's because good people get involved in Ponzi schemes and deals that are subject to fraud, unfortunately, pretty often. Now, in 2024 alone, the Federal Trade Commission reported that there was over $12.5 billion lost due to fraud. Okay, now not all fraud is actually a Ponzi scheme. Okay, we're going to define that, what a Ponzi scheme is here in a second. But just fraud alone, $12.5 billion, that's a lot. Okay, 5.7 million of that was actually to an investment scam. Okay, and this is a 24 to 25% increase over 2023. So the problem is actually getting worse, not better. Now, most scams incur in two areas, which is the bank transfer, essentially whenever you as an investor move money, okay? It can be through a wire, ACH, or whatever. It's in the process of moving money. And that's where a lot of the fraud and investment scams actually occurred. And then also, unfortunately, around cryptocurrency. Now, I know there's a lot of people here that love cryptocurrency. I'm beginning to wrap my head around cryptocurrency. I've been trying to study it for years and understand its role in my portfolio. But those are really, according to the Federal Trade Commission, those are the two big areas that people experience fraud and scams. But that's not to say that it can't happen in private equity investment or even in real estate, okay? Now, here's the thing. The reason why we want to understand how to suss this out and protect ourselves as much as possible is because the obvious is when we experience investment fraud or some sort of scam, there's a capital loss, right? We lose money, okay? That money can erode our savings because we have to, until we potentially can be made whole, not all the time do people who are in a Ponzi scheme or some sort of fraud scheme, oftentimes they don't even recover their money, right? So they have to resave all that money to invest. Okay, so capital loss, eroding savings. Okay, this can erode our wealth building. Okay, those are the three big mechanics that most people can wrap their head around. But the softer side of this, the reason why we want to avoid the loss is that if you happen to experience a loss, it can actually throw you for an emotional investing loop. Okay, maybe even just an emotional loop, right? It can damage trust between you and other operators and other assets that you potentially want to invest in. And it can cause a lot of emotional distress. Okay, to the point where some people will stop investing altogether. Right? Now, this is what I want to do. I want to empower you to kind of suss out different types of fraud and try to avoid going into investments that might have a fraud component to them before you ever write the check, right? We want to figure this out ahead of time. But here's the thing. I want to make sure I draw a clear line here. Investments, depending on the market, okay, there are some investments experience trouble. Not all investments will be a success, right? They may experience a market condition or, some sort of like business plan interruption. Okay, that is different from what we're talking about today, which is clear fraud, meaning that the operator went into this intentionally to misrepresent the investment. They went into this to intentionally embezzle money away from the investment. Or maybe they're the scheme of all schemes, nefariousness of all nefariousnesses, and if that's English, right? That they intended to actually build a Ponzi scheme. Okay, so what is misrepresentation? Okay, this is where a fraudulent operator might actually misrepresent the performance of an investment or the nature of the underlying assets in order to get investors, right? Essentially, the investor is making a decision based on false information. But here's the thing, the operator knew that. They did that intentionally. That's misrepresentation. Okay, then you had embezzlement. Okay, this is where individuals entrusted with managing investor funds siphon off money for personal use, okay, leading to loss to the investor. Now, embezzlement can happen in all different layers of that operator's business. It can be the operator themselves, or it can be somebody else on another team that unfortunately has access to the money and they embezzle. Okay. Then you've got your Ponzi schemes. Okay. Our robber of all robbers. This is where somebody designs the investment to where returns are paid to investors using capital from new investors rather than from legitimate profits of the business. Okay. These schemes will eventually collapse when there's no more new investors to pay the returns to the early investors. Okay. They actually collapse. Now, here's the thing. You can have a legitimate investment, and then at some point in time, the operator goes, oh, I'm going to start misrepresenting returns in order to bring more money in. Or, hey, the getting's good. I'm going to start siphoning off some of this money to pay my bills. Or they are just like, ooh, you know what? Why do all the work? I'm just going to create this nice investment package and I'm just going to use new investors' money to pay off the older investors. Okay. Kind of like our Bernie Madoff. Now that you understand why we want to make sure that we suss this out before we actually get into a deal, and that there's actually different types of fraud that we could potentially deal with, and they're not all Ponzi schemes, right? There's different types of fraud here. How can we potentially spot this nefarious activity before we actually become a part of that investment? Well, there's a four-prong approach here that I'm going to walk you through. One, we got to understand the warning signs, okay? What, potentially are those red flags we should be looking at? Okay, two, we need to understand how to do complete due diligence on the operator. Then we have to understand how to do complete due diligence on the investment. And then we got to learn how to listen. All right, let's dive in. So, some warning signs. This is not necessarily an exhaustive list, but some warning signs to be aware of, whether it is misrepresentation, embezzlement, fraud, Ponzi schemes being our worst case offender, okay? They tend to have multiple of these kind of red flags, meaning there's oftentimes a too good to be true return, all right? The operator might use words such as guaranteed return, or you're going to get this insane return with no risk. Okay, those are the two kind of like guaranteed and no risk. Those are like alarm bells are going off in my head. Okay. I never say guaranteed to any of our investors. Matter of fact, if somebody asks me on an investor call, hey, what's the guaranteed return? I'm quick to tell them there is no guaranteed return. If anybody ever says that, run, 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 run. Okay. All right. Number two, lack of transparency in the financials and how returns are generated. Okay. So this, for any investment I go in, I want to see at minimum quarterly financials. Okay. I want to see how the money is being, how the income is coming in. What are the expenses to the fund? I want to be treated as a partner. Okay. I'm not just somebody that you sent a check to. I want to be treated as a partner. All right. Operators that rely heavily on new investor capital to pay old investors. Okay. Classic definition of a Ponzi scheme. All right. Now, essentially, if new money comes in to secure an asset that will go into the fund, that is very different. But if an investor's return is going to halt because no new money comes in, okay, that is, now we're kind of talking about a Ponzi scheme. All right. Now, if an operator doesn't have a verifiable track record, or there's a really vague background component here, you really can't find much about them. And what you find about them is like, kind of mediocre at best. Okay. That's a red flag too. Sometimes operators, let me go back a screen, overcomplicate the structure and the investment, hoping that you just go to the trust me, it works part. Okay. Believe the thousands of other investors that I have in here. Okay. Believe your friend who is in this investment too, right? They overcomplicate things in order to help you, encourage you to push off your due diligence. Okay. Or they overcomplicate it so you just can't follow the money. Another warning sign to be aware of is high pressure sales. Okay. Now there is urgency to invest because the operator actually has to go to the closing table to close on a multi-family deal or an express car wash, right? And they need money in order to close, okay? Or it is, kind of usually these Ponzi schemes and stuff like that are open-ended funds, and there's like act now or you're going to lose out, right? Those high pressure sales tactics, are also a warning sign to pay attention to. And then just poor communication and lack of investor updates. Now now that you understand the warning signs, we want to pick apart, how do you start sussing out whether what you're feeling, what you're seeing is tangible or not? How do we slide this into our due diligence of the operator and of the investment? Okay. So again, step one, understand the warning signs. Step two, let's make sure that we're vetting the operator appropriately. Now, if you follow my passive investing made simple boot camps, I dive into really deep structures, walking new investors through how to set their goals, their risks, their timeline, and helping them understand what asset classes should be in their portfolio. How should we look at numbers? How do we vet operators, markets, and deals? How do we track our portfolio? We go through all the mechanics. Okay, so I'm going to direct you back to those webinars on our YouTube page to get a full understanding of how to vet an operator. But most importantly, what I want to communicate to you today is that most investors skip due diligence, either partly or in full altogether. Okay, the investor can get so excited about the returns and that the deal is closing pretty soon, or that it's somebody that their friend trusts, and they cross their fingers, their friend did all the due diligence, that they overlook the operator's credibility. Okay, and what position that puts in that investor in is that they're relying on word of mouth as opposed to verified details that they did, verification that they did. So again, I encourage you to go back to look at those boot camp webinars. Okay, those are going to go through very detailed questions on how to set up your due diligence sheet of the operator, but some big questions that you want to make sure are there, just out of today's conversation is, who is the operator? What is their track record? What is their background experience? How do they structure their deals? How do they handle investor funds? Who on their team is actually touching money and has access to your private information? You want to know that, okay? Do they provide full transparency on financials and on distributions, okay? Is that information at your fingertips? Like, can you log into your investor portal and see an update of your investments in real time? Or at least at the close of every month or of every quarter? Does the fund have verifiable underlying assets? We're going to talk more about that in a minute. Could you actually go touch and visit the asset? Okay. Could you review loan tapes if you're looking at a debt fund? Okay. Could you see some sort of list of assets that actually back the investments of that fund? Okay. If assets are being purchased, is there going to be a verification of the actual deployment of the money into that asset? Okay. How are you going to know that your money was actually deployed where it should have been going? All right, so kind of an added layer of due diligence here that I encourage you, everybody here, to put into your process is, if you're investing in, say, like a single asset deal, a single asset entity, maybe like one multifamily in an LLC or one self-storage building in an LLC, confirm the physical address of the investment to make sure it actually exists, right? If you're investing in a portfolio of funds, okay, or a portfolio of assets, and you have the addresses for all the assets, go look them up on Google. Make sure that they're there, okay? Maybe call a local realtor if you can't go and visit the asset and just kind of like, walk around and look at it. See if you can call somebody locally and they just go, yep, that exists. Yes, it was for sale. Yes, somebody is buying it, right? If you're investing in a debt fund, you can request loan tapes, audited financials, or a list of financials. You can maybe even reach out to property management companies to confirm actual assets exist. You can also talk to CPA firms, okay, to kind of vet the operator too. Like, are they investing in assets that actually exist? Okay, it's really hard for somebody to hide an asset whenever they're working with an accounting team, okay? Number 2, review disclosures and offering documents. Hopefully you're doing this. Hopefully you're reviewing end-to-end the offering memorandum, the subscription agreement, the operating agreement, the private placement memorandum, okay? But make sure you're paying very close attention to the terms, the risk, and the fees associated with the investment, right? And then make sure that you're actually going on the Security and Exchange website, EDGAR filings, and making sure that the company that you're investing in is filing their EDGAR filings. Now, oftentimes for syndicated real estate, the EDGAR filing happens after the close of the asset. So you want to get previous asset names that have been raised for, and that the operator is actually going and filing their EDGAR filings for those. Okay, another website It's a little bit easier to read. It's called formsd.com. But at the end, they pull the Edgar database. Okay, so might as well just go straight to the SEC. All right, now remember, we talked about that actually the area that most people lose money is not in actually an investment imploding. It's actually when they move the money, okay? Something nefarious happens at that step. So hands down, in any investment you go into, before you transfer any funds, I love transferring via wire, okay? It's instantaneous. I can get a confirmation, but I also want to confirm the wiring instructions with the operator before I actually make the wire, okay? Because it's kind of hard to get the money back if fraud was committed in there. Now, this even goes if you're closing your own, buying, say, like your own single family rental or your own multifamily rental. Wiring fraud happens more so in those transactions than I believe it does in the passive real estate realm. But nevertheless, always confirm. Anytime you're going to wire anything to anyone, any business, confirm the wiring instructions, ideally over the phone. Okay. Also, you know, wiring instructions that are sent via email or via text, those can be two of the largest non-investment category scams that there are out there. Okay, so again, confirmation. And then just stay informed of your investment. Okay, monitor the financials, monitor like what's happening in the news around your investment, right? I would like to say passive real estate is 100% passive, but you still, as a passive limited partner, you need to be kind of keeping your thumb on the pulse of what's happening around your investments. Okay, at the very least, read your updates, read your financials. All right. So we talked about how to vet the operator. We talked a little bit about how to vet the deal. I want to show you kind of a case study, and I'm being vulnerable with you guys right here. I want to show you how I lost $100,000. Yes, it stung. I was in tears when I had to like tell my family, oh my gosh, this money just went poof. Okay, could I reclaim it on my taxes as a loss? Yes, you're darn tootin' I did. I worked with my CPA on that. But at the end of the day, I was supposed to be earning a return on that $100,000 and I lost it. Now, here's the thing. The investment, I believe, actually started off as a very legitimate investment with an operator that had been operating in this bad debt space for over 15 years with very positive returns. Now, here's the thing. The operator, unfortunately, thought he could raise his way out of the deal. Okay, what happened? He brought in a partner that embezzled money. Okay, he didn't take the money, but he brought in another partner, and that partner siphoned off all the money in the fund, took the cash. But here's the thing, the operator, as opposed to going to the investors and saying, hey, yo, this is what happened, he thought he could raise his way out of the deal. So now he took a bad situation, which was fraud, embezzlement that happened, and he turned it into a Ponzi scheme. And that Ponzi scheme continued until COVID struck, okay, where the capital raise actually collapsed because he couldn't bring any new money in to pay off the other investors when he should have just come clean, right? All right, so what I missed in this deal is a big piece of the puzzle is that there was clearly the operator in the PPM stated that he could cross-collateralize other businesses in the portfolio. And the partner didn't embezzle directly from the bad debt business, okay? He embezzled from another one of the operator's businesses, okay? And when that business went under, the operator started siphoning money over, right? It was clearly outlined in the PPM, but that's what happened, okay? Another thing that I missed is that the operator actually had a previous bankruptcy, okay? That should have been a red flag. You know, heaven forbid, I believe, everybody has the right to recover from, their past mistakes. But for me, as an accredited investor, I get a choice on who I invest with. I should have done that more complete due diligence. Now, when I stopped getting the audited financials on the deal, okay, because again, this is like not a real estate fund. It's very hard to see the tangible assets. I was relying on the audited financials. That should have been a red flag to me. I should have been going ding, 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 let me out, let me out, let me out. Now, here's the thing. I did get more, over 3/4 of my investment back, okay, because I had more money than just this 100K in the fund. But the operator, instead of disclosing when I started liquidating my shares, instead of telling me what was going on, he decided not to tell me, and he continued to pressure me to keep that other $100,000 in for just one more year. It would really help him out, okay? All right, so there was I take a lot of responsibility too for losing this $100,000. Now, here's the thing, bad things happen to good people all the time. How do they deal with them? That is you want to be with the person that deals with it with integrity upfront, taking on the situation to rectify it. Now, for a lot of you here, you might be sitting here going, wow, this is a lot of information, Whitney. I'm never going to do this entire checklist. What are the big things that I need to add in right now to my underwriting to make sure that, to at least like eliminate a good chunk of the outcome here that I might actually get involved in a Ponzi scheme or worse. And that is going with the 5-minute gut check framework. Okay, so again, make sure that you're doing your background checks, search for past lawsuits, SEC filings, any sort of complaints. You should be doing this anyways, track record review, verifying previous deals, investor returns, making sure that you're getting the transparency that you deserve as a limited partner, okay? And that is the financials, but also the regular communication. I'd also challenge to ask operators tough questions before you invest with them to see how they respond. Okay, again, you want to be working with somebody who's going to treat you as a partner. And then, it does not hurt. Talk to investor references. Speak with past investors about their experience and ask them what's gone well, what has been challenging, right? Okay, you're not looking for somebody who's perfect. You're looking for a great business partner, somebody to be COO over your investment. Now, guys, I want to wrap up and open up the floor for our Ask Me Anything part of the show. But again, I offer you up a framework, okay, a more detailed framework and then like a quick step framework here. You can choose which of the two you include in your underwriting and due diligence. But just know that this will not catch 100% of nefarious activity out there. Bad things still happen to good investments. Okay, so again, understand the potential warning signs, make sure you're doing your complete due diligence on the operator, due diligence on the deal, and then don't discount your gut feeling. Now, this is my invitation to you before we open up the floor for questions is to join the Passive Investing Club. In the Passive Investing Club, you get access to a free one-on-one call with me to understand your investing goals and how we can help you here at passiveinvesting.com. You get access to all of our educational information and most importantly, access to our open deals.